Welcome to Stocks in Translation, Yahoo Finance's latest vodcast that cuts through the noisy numbers, the jargon, the hyperbole, the mayhem to help you make the best decisions for your portfolio. I'm joined as always by our all-star producer, Sydnee Fried, and I'm very excited that Michael Darda is also joining us today. He is the chief economist and macro strategist at ROTH. Hi, Sid. Hi, Michael. Thank you so much for joining the show today.
Thanks for having me on.
And we have a fun topic to talk about. It's something that I feel like investors, it's been on the minds of a lot of traders out there for the past, several years, I would say, and that is recession. It is our theme of the week. One of the scary economic possibilities that could happen, especially with the unemployment rate rising, the Fed weighing its next interest rate decision. That brings us to the word of the day, which is volatility. Safe to say, September, not a great start for stocks. S&P 500 dropping more than 2% to kick off the month's first day of trading. What has investors so concerned? This is a key question that we're going to be tackling today. And this episode is also brought to you by the number 34. That's the number of U.S. recessions since 1857, according to the National Bureau of Economic Research, otherwise known as the NBER. But let's get to it with the theme of the week. And Michael, we said it, stocks not doing so hot to kick off the month. S&P 500 dropping about 2%, the worst drop since 2015. Heightened concerns that the tech bubble is bursting. We mentioned the unemployment rate. Just so many things going on right now. What's your big picture view when it comes to where the economy is heading?
Sure. Well, I think taken into context, we're getting a bit of a pullback here after essentially a 2-year straight up equity market. Okay, so going back to 2022, we had a pretty bad market year that year with the S&P down 25%. So it's just been a rocket ship since the fall of 2022. And, we went almost a year without a 2% pullback until the volatility started in the middle of July of this year. Mm-hmm. So this is actually more normal than what we were dealing with before. And there are questions about the economy and the business cycle, stock market valuation. So what's unfolding now actually makes a lot of sense to me.
Are investors being a little dramatic by, bringing around the recession word when it's clear from other indicators that we still have like a strong economy in many ways? Is it dramatic?
Well, the recession word does tend to come up pretty frequently, and it tends to come up when you get equity market volatility. And so it was pretty interesting in that this pullback that started in mid-July and then reversed until just this week set off alarm bells about the Fed being behind the curve, maybe should do 75 basis points intermeeting before the actual formal meeting on the 18th.
That seemed a bit dramatic
right?
at the time.
I kind of wanted it to happen, by the way, just for the drama.
Just for the drama, just for the plot.
So, yeah, completely dramatic in the context of the consensus view before the volatility storm hit this summer was soft landing,
right,
smooth sailing. And so I think what ends up happening is the R word is sort of thrown out there anytime the stock market starts to stumble. And we saw that writ large in 2022. And we actually had 2 down quarters of GDP in the first half of 2022 and a bad stock market year. And we were fighting this argument the entire year that, a recession, people assume it's 2 down quarters of GDP. Mm-hmm. That usually happens, but not always. We've had recessions where there are non-consecutive down quarters, but in every single case, you see a rising unemployment rate, and that was not what was taking place in 2022. But for us, we try to be consistent, and so that year looked a lot different than what we're dealing with now, which is been this incredibly robust equity market, but some cracks in the business cycle foundation. It has been a soft landing for 13 months since the Fed stopped raising interest rates, but that's not unprecedented to have a slowdown period that looks like a soft landing and then a recession ends up taking shape. And it's sort of unexpected now because I think many have been lulled into this idea that the soft landing is sort of going to be a permanent state of affairs for the business cycle, and that equity market valuations reflected that coming into the summer. So I think we're skating on ice here that's a bit thinner than a lot of people presume. So
back it up. What is a soft landing?
Okay, yeah, absolutely. So the idea of a soft landing is that after a period where the economy is growing above trend, and you know, if you're coming out of recession or you're coming out of this huge slump in 2020 with the COVID shock, you need to have above trend growth for a while to get the unemployment rate to come down to normal levels. But too much of a good thing means high inflation, right? So with the economy booming coming out of 2020, we got a 2-year period of elevated inflation. So the Fed's goal with the rate hikes, raising short-term interest rates 530 basis points, the goal wasn't to topple the economy. The goal was to slow demand in a way where supply could catch up and inflation would come down. The Fed knew that would create a risk of recession, but that wasn't the goal in and of itself. The soft landing is simply you go from above trend growth to growth that is in line with potential or trend, meaning the sum of productivity growth and growth in the working age population. And that would be a balanced economy where inflation is about at the Fed's target, but low and steady.
Let's get to that dual mandate of the Fed, right? You were talking about inflation. Obviously, that's a goal of the Fed to bring inflation down, but they also want to protect the jobs market. And we have seen that rise in the unemployment rate, 4.3%. You say that that's an important trend for investors to watch.
Right.
Why? Why is that so important?
So with the unemployment rate, it's not just the level, which, 4.3%. Historically, that's very low. I mean, that would be defined as full employment. So things look pretty healthy from that perspective. But the change in the level, the trajectory, really tells us a lot about what's happening in the business cycle. When the unemployment rate is falling, the economy is usually growing above trend, sort of the definition. So slack is diminishing. If you're growing below trend or below the growth rate of potential, then slack is increasing. The unemployment rate is going up. And usually that involves an actual contraction in the economy. So we haven't seen that yet, at least in the published figures. I mean, GDP growth has still been positive. But the unemployment rate has been creeping up from the cyclical trough in the fall of last year. In January and April, we bottomed out at 3.4%. So we're almost a full percentage point off of the lows of the cycle. And if you go back and look at all the business cycles since the end of World War II, for which we have data, any kind of a rise like that over a similar period has involved a recession starting. And just, year over year, if you take like a 12-month change, we're up 0.8 of a percentage point. Literally unprecedented outside of the end of a business cycle, start of a recession. Now, jobs are still positive, GDP is still positive. So the question is, okay, well, maybe the unemployment rate is just wrong this time. It's a little dangerous because we know that job growth, which comes from a separate survey of establishments, sometimes is positive into the first few months of recession. And in fact, we had one recession, which was a bad one, 1973-75, where payroll growth actually was positive for 9 months after the business cycle peaked. And that was also, a very overheated labor market, a high inflation period going into that recession. GDP growth ends up revised dramatically at business cycle turning points. There was a great chart floating around a few weeks ago that showed the 6 revisions to first quarter GDP in 2001, the first quarter of recession. And we went from 2%, the initial estimate, to a final estimate of minus 1.3. The unemployment rate really isn't revised. So I think if we have concerns that we might be at a turning point, it makes sense to take the unemployment rate data at face value, and that is a bit concerning. And this is really where the debate is. Why is it rising? Is it okay because the labor force is growing fast, or we have this impulse from immigration? Is it a benign rise this time? And, some of the arguments are with payrolls positive and GDP positive, don't worry about it. And I'm not completely sold on that argument.
Who do you trust? How often, 2 questions. How often does any specific data point, is it wrong and it has to be dramatically changed? And then 2, can you define, go with that first, then I'll do my second question.
Yeah, I mean, I think unfortunately, the government agencies do the best job that they can do, but they're not working with complete data sets. Everyone wants the information quickly, but when initial estimates come out, they don't even have complete data for something like GDP. And so the first estimate is simply incomplete. They do the best that they can. Response rates post-pandemic have been really low for a lot of these surveys. So unfortunately, we are sort of flying blind to some degree. And this is where I think you probably want to lean a little bit more on some of the survey-based data. And we can look at...
So what's an example of that?
Well, it would be, an example of that would be the ISM Manufacturing Index data that we got this week for August, or the Conference Board confidence measures that also have some subcomponents that track the labor market. And we can look at those series and ask the question, does this look similar to GDP and job growth and earnings estimates, or does it look really different?
Is 4.3% itself a bad unemployment rate?
No.
What's a bad unemployment rate?
Yeah, I think if Fed Chair Powell was here, he would say, we want the lowest unemployment rate feasible, but with price stability, right? So if we could temporarily drive the unemployment rate down to 2% or 1%, but the cost is a big surge of inflation, that's not a sustainable environment. And so, what the Fed can do is to try to create an environment of price stability where we have that in expectations and in terms of the data that's coming in, and then the unemployment rate finds its level. And the hope is that, it would be historically low. 4.3% on a historical basis is actually quite low. So if you go back to the decade of the 80s or the 90s, even a lot of the 2000s, I mean, that's an incredibly low unemployment rate level. That looks quite good in the historical context. The problem, if there's a problem, I do think there's a little bit of a problem, is that we're up to 4.3 from a cyclical trough of 3.4. Those kinds of movements in the level tell us that the economy, if it's still growing, is growing below trend, below the growth rate of potential. There's an exceptionally fine line between that and an actual contraction recession. They do happen. Recessions on average happen about every 5 years. We've had a few business cycles that have been 8 to 10 years long. And they typically happen after a period where the Fed has raised short-term interest rates quite a bit, which
we've seen
just occurred. So
unemployment really a trend story, all relative. There's no one-size-fit-all approach, which is a really interesting thing to continue to weigh and really think about, especially as the Fed decides what they're going to do with interest rates moving forward. We're going to take a quick break, but coming up, we take a closer look at the volatility story on Wall Street. That's right after the break. Stay tuned. Volatility, that is our word of the day. Markets, commodities facing volatile swings to kick off the month of September as traders assess global growth concerns amid greater fears that the U.S. economy could be slowing down. So, Michael, under the hood here, we've seen some pretty sizable swings to the downside here. One thing that comes to mind is tech, right? We've been talking a lot about AI. Are we in a bubble of sorts? What do you make of what's going on in mega cap stocks right now, especially as it relates to tech?
Yeah, critical question. So I definitely think we're in the throes of a bit of a frenzy. Bubble is kind of a loaded term.
What does bubble mean?
Bubble basically means that you have a unsustainable set of valuations on certain securities, and that there's a big reckoning that tends to follow that. I use the word frenzy, so I do think we, with the AI revolution, and it is revolutionary, I mean, I really do believe it's real and it will be transformative, but these kinds of bursts of innovation also tend to give way to over-optimism and some degree of hype. And when valuations do go up a lot, that means the expectations are high. So if things start to go wrong, a recession occurs, or let's say that profits don't live up to expectations, then you can quickly find yourself in an environment that looks more like a risk-off, higher volatility backdrop, which is what we've started to see since mid-July.
And profits has been a big focus. These companies' bottom lines. We got the latest earnings season data, and it was a few interesting takeaways for me. One being about the state of the U.S. consumer. We've seen a consumer that's pulled back a little bit, a little more choosy. There also seems to be this bifurcation nature between the higher income consumer, the lower income consumer. What have been your biggest takeaways from this latest earnings season? Because I felt it was a bit of a turning point than what we've seen in the past.
For sure. Well, we're seeing companies that had been soaring off of repeated beats on either revenues or earnings not do so well in this most recent period. And what that tells me is that the expectations have just gone up so much, it's impossible to beat expectations indefinitely. Eventually, they catch up.
Isn't that a good thing, though?
Yeah, it is a good thing.
Yeah, it doesn't make any sense to me.
Yeah, it is a good thing, but I think it can also be a little bit dangerous when you have investors that are chasing some of these super hot stocks and hot sectors, infotech, the AI stocks, and they just simply are making an assumption that it's always going to be up and to the right.
The FOMO trade, perhaps?
FOMO trade,
yeah.
beat and raise, beat and raise, beat and raise. There was a shocking quote in the Wall Street Journal this week. You may have seen it, but it was talking about how retail investors are incredibly bullish on the stock market because of the last 2 years of gains. And there was a man in his late 60s that was quoted in the article saying the conservative strategy is to be all in all the time. Now, that is a terrifyingly high level of optimism.
Retirement. That's
exactly.
dangerous.
Right? This sounds like 1999. So I'm not going to use the term bubble, but I will say we're in a bit of a frenzy here. The expectations are super high. And, if things start to go wrong, whether it's the earnings not living up to expectations or the business cycle faltering, that's when you see stock markets roll over, and potentially in a material fashion. I mean, what we're dealing with so far is nothing off the valuation levels that we're seeing, 20, 21, 22 times very optimistic forward earnings estimates for the S&P 500. If we do not have a perfect scenario unfolding before us, I think that probably spells trouble for the broader marketplace. That doesn't mean every stock in every sector, but the sectors that dominate the S&P 500 are about 40% of the market cap of the index, infotech and comm services, and those are high valuation sectors where there's been a lot of FOMO, a big frenzy. And so we're bearish on those areas right now.
So quickly, how do you play that then? What's the investment strategy?
Well, I think that really depends on how much risk the investor wants to take on. How sophisticated they are as an investor. I mean, there are all kinds of things you can do with trying to time and bet against markets. That's really typically not advisable for most investors. Most investors really should play a slow and steady game where they're diversified, but they don't react to market swings, because what tends to happen is you don't realize that a market swing has taken place until it's largely over. And so if investors listening are trying to react in real time, typically they won't succeed in doing it. But our view has been to stick with the more defensive sectors of the S&P 500. So when the 10-year Treasury yield ran up to 5% last year, the utility sector was really flat on its back, big bear market in that sector. So we recommended both bonds, the long end of the yield curve, and the utilities. And it was a very controversial, non-consensus view at the time. Since then, the bond yields have pulled back, obviously, with a slowing economy, lower inflation, Fed rate cuts being priced in, and the utility sector has really done quite well. But that comes after a terrible performance in 2022-23. So what I think investors should do is either do nothing, just set it on autopilot, with a diversified approach that makes sense for their age and risk tolerance, or if they are going to do anything, I would recommend sort of leaning against the current a little bit. If you have markets that have soared for 2 years, probably want to be a little bit more conservative. If we end up with a 25-30% correction bear market, that's the point at which you'll want to take on more risk in terms of broad-based equity exposure. In 2022, that was a chance, and a lot of investors didn't take the opportunity because they thought, well, this is just going to continue.
So speaking of the risk story there, I want to move on to our segment called Who Wore It Better? And I'm excited to get your take on this because the start of August versus the start of September, both volatile monthly starts for the markets, both historically slow trading months. Was one more of an overreaction than the other? Was one more a fundamental play than the other? How are you viewing those two starts?
What started to unfold in mid-July, where we had a very sharp but short-lived, it was little over 8% pullback in the S&P 500, more than that for the leading sectors of the market. And then it just reversed, right? We ran up almost to the highs until, coming into this week where we're pulling back again. So the pullbacks don't really surprise me in the pickup in volatility. What surprised me was that after not even a 10% decline, after this 2-year period of straight up into the right markets, we reversed that so quickly and almost ran back up to the highs. So I do think we're probably in an environment now where volatility is going to stay elevated. The risk of a more material pullback and or correction is quite high. That will also bring opportunities, but I think what we saw for the last 2 years with this market backdrop was quite incredible, unexpected. From these valuation levels, and based on where I think we are in the business cycle, I think we're going to be in choppy waters for a little bit.
So, we talked a little bit about your investment advice. Mm-hmm. Maybe for a younger investor, do you think that you should just kind of invest in a bunch of ETFs and kind of let your money stay the course and kind of stay away from individual stocks as we do experience volatility?
Yeah, I think for younger investors, it's okay to play around with individual stocks as long as it's a small share of their portfolio. One of the many benefits of being young is that you have time to make up losses if you make some mistakes, right? And so it's fun to play with individual stocks and make those bets, but my recommendation for young people is just don't do it with your entire portfolio. So you can make the mistakes, and if it's a percentage of the portfolio, you can recover and you can come back. The older someone gets and the less time they have in the market to make up those mistakes, then playing the individual stocks should be an increasingly small portion of the portfolio. Unless they're professional, sophisticated investors, they're dedicating their life to doing it, that's a different scenario. So I think if you're young, my advice would be get into the market, stick with the market, go ahead and play around with individual stocks if you want, but understand that should be a small percentage and it should be a shrinking percentage over time. But young people have time to recover when they make mistakes, and we all make mistakes as investors, and that's part of the game.
Well, so one last question in 30 seconds or less. What do you do on days you just don't understand the market?
I usually take the dog for a walk.
The dog. I heard your dog's famous.
Yes, yeah. We have an 8-year-old Weimaraner who's made a whole host of financial media appearances, starting during the pandemic when, we didn't go into the studio. So, the transition to Zoom for a lot of these interviews meant that he could sit right next to me. And and so now, he's become a Google search actually. So if you're looking for anything I've done, if you put my name in, it'll just kind of throw Klaus in there as well. So.
Everyone do it now.
Right. Michael Darda, thank you so much for joining us. That went by so fast. That is it for today's Stocks in Translation. But make sure to check out all of our episodes on the Yahoo Finance mobile app and website. We're also on all of your favorite podcast platforms, including YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. Keep it here on Yahoo Finance. We'll be back with much more coverage ahead. Thanks so much.